Greetings to all the learners. Today we are starting with the series of Security Analysis and Investment Management. Security analysis and investment management is a very interesting topic because when it comes to funds, when it comes to our hard-earned money, it is really very important to understand where to park our funds, where to put our hard-earned money. So in this series, we are going to discuss the various alternatives, the various options which are available to us in the form of investment, for the purpose of investment. To begin with, please permit me to introduce myself. I am Dr. Isha Raval and I am working in the capacity of Associate Professor and IQAC Coordinator at Vivekananda Institute of Professional Studies, Technical Campus, Delhi. Yes, so when it comes to investment management or when it comes to identifying the various alternatives of investments, there are a number of options. The moment you say that you want to park rupees 1 lakh somewhere, you will get a lot of investment advisors around you. But they come and they offer you different products. The moment you pick up phone calls, you start getting phone calls. Please buy our insurance policy. Please invest in this ULIP plan. And we as an investor are actually clueless that what these products are, or should we actually invest money in these products? So today we are going to deliberate upon what are the different investment alternatives as an investor you can opt for, and what is the duration, the pluses and the minuses of all these investment alternatives. As you can see on the screen, the first investment alternative which we are going to discuss is non-marketable financial assets. What are non-marketable financial assets? The assets which actually cannot be sold in the market, the assets which cannot be transferred to somebody. For example, if you open a bank deposit, if you park your funds in an FD, or if you put your funds in a post office time deposit, if you create a company deposit, or you just park your funds in, say, NSC, which is National Savings Certificate Scheme run by the Post Office, the Government of India. Once you buy these products or once you put your funds in these products, you get bounded. You really cannot take out your funds before the maturity of these financial assets. So being an investor, you need to understand what is your risk appetite. If you are looking for security of the capital, the safety of your funds, being a conservative investor, you may opt for bank deposits, you may opt for post office time deposits, you can open a recurring deposit with the bank. So these are the options which you have. If you are not a conservative investor and the risk appetite is really high, the second option which comes to your mind is that you want to invest in the stock market. Now, when it comes to stock market, you think of equity shares belonging to maybe from the category of blue chip companies or mid cap companies or small cap companies. Blue chip companies are usually the favorite products of the investors. Why? Because they are part of the Sensex, they are part of Nifty 50 and you find them really secure. Here again, if you talk about equity investors, the equity investors do analysis, they do fundamental analysis, they do technical analysis, and at times they go on and they do quantitative analysis before making before making the investment. Now, blue chip companies are those companies which are, because they are part of Sensex, because they are part of Nifty, they are part of the big fours, that is why they are considered to be safe. But the quantum of return which we expect from these blue chip companies is pretty less vis-a-vis the small cap companies. Being an investor and looking at the risk appetite of yours, we need to take a call whether you would like to go in for blue chip or whether you will prefer going in for small cap funds. After equity shares, the next investment alternative is bond. These days the bond markets is actually developing a lot. People prefer investing in savings bonds, they prefer investing in the bonds issued by public sector undertakings, the debentures of private sector companies, and even gilt bonds, the bonds issued by the government of India. These are also known as government securities. Now, the major difference between equity shares and bonds is that when you invest your funds in equity shares, you become the owners of that company. You get the ownership. But when you invest in the bonds, you buy the bonds of a private sector undertaking, or you buy the bonds of a PSU, you are actually giving them a kind of a loan and you do not get any sort of ownership. Again, the return expectation is a little higher when you invest in equity market, whereas when you invest in bonds market, when you buy government securities, though they are considered to be safe, the return is equally on the lesser side. The next investment alternative is, as you can see on the screen, is money market instruments. There are a lot of money market instruments, but these instruments are meant for those people who have an investment horizon of less than 1 year. So somebody who wants to put funds for, say, a period of 14 days, wants to put funds for maybe for 1 month, for 6 months, they can opt for money market instruments. And most of the banking transactions, the financial institutions, they indulge in call money because they have their certain requirements to be fulfilled. They have the CRR ratio, they need to meet the SLR, and they are the ones who cater to the money market instruments. The another important money market instrument is your T-bills, which is also known as treasury bills. They are considered to be secured, issued by the government of India, bear a particular coupon rate, a particular rate of interest, and are considered to be relatively safe. Commercial papers are issued by the private sector, while we have certificate of deposits as well. So if all in all you're looking for an investment with a duration of less than 1 year, you opt for money market instruments. Now, there are many people who have no clue about stock market. They do not have any clue about the bonds market, but they want real returns. The option which is available to them is mutual funds. Mutual funds are managed by asset management companies, the AMCs, and what they do, they have a lot of assets under management. They create pool of funds from different individuals, and then they invest these funds as per the requirement of these individuals in the stock market. We have different categories of mutual funds. The first one is growth mutual funds, the funds which are preferred by aggressive investors. Now, growth funds are the funds wherein 80% of your money is going into the equity market while 20% goes in the bonds market. Or we can say people who have a high risk appetite, they prefer to go in for growth mutual funds. Why do we call them growth mutual funds? Because the rate of return is on the higher side. The next category is balanced mutual funds. Balanced mutual funds, they usually maintain a 50-50 kind of a ratio. The 50% of your funds go in equity market, while the remaining 50% are invested in safe securities, in government securities, or in bond market. But the investors who really do not want to take much risk, they prefer investing in the safety mutual funds. People who are very conservative, have low risk appetite, but they really want to have a flavor of the stock market. They want returns, but they cannot risk their funds a lot. They prefer investing, the conservative investors, they prefer investing in safety mutual funds. So all in all, we have three categories. Once you start investing in mutual funds, you have the option of shifting from one category to the other, depending on the kind of return one is getting. The next one is your insurance. Every individual in India they think that insurance is actually investment. But when it comes to life insurance, we are actually insuring our life so that our near and dear ones do not suffer once we are no more there in this world. They opt for this sort of investment. So insurance is actually catering to the safety need of the individuals, wherein they want an assurance that after they are gone, they are no more there. If they are the bread earner and they are the ones who are actually generating funds and they are no more there, what is the security for the people who are left behind? So that is why the first instrument which they buy, the people who think that They are really conservative, they want surety of return, and they want the money to be back at least for their family when they are not there. They opt for life insurance. The other category is general insurance. Under general insurance, we have automobile insurance, accident insurance, and even your Mediclaim. The medical insurance policies comes under the category of general insurance. And these days, medical policy or Mediclaims or medical insurance is the need of the hour. So after life insurance, the next thing people opt for is the medical insurance. Next alternative is the real estate. The real estate sector is booming these days. The property prices are rising, and the problem with this sector is that there is no MRP. So if you are going to go and buy a floor, you wish to buy some agricultural land, or if you want to buy some semi-urban land, or if you're looking for a commercial property or a shop, or maybe you are trying to buy a piece of land, the problem is that there is no MRP, the maximum retail price. So how can you identify that the price which you are actually paying for this land is the correct one? So people usually resort to dealers. Whereas as we discussed in the stock market, it is a little regulated market. The bonds market, it is a regulated market. The money market instruments are regulated. The deposits are regulated. But if you look at the real estate sector, this is one such sector where there is no maximum retail price, or in fact there is no minimum retail price. We do have these circle rates which set the benchmark that below which the deal doesn't take place, but when it comes to the maximum, there is no limit. So that is why people, when they consider how conveniently they can invest in the real estate sector, they face a lot of problem. But people who have surplus funds, people who want to build empires, and they have a lot of funds, they prefer investing in the real estate sector. Now, when it comes to a country like India, the females especially are fond of gold. When the festival season, and the safest investment which is considered by females is gold. So the other investment alternative available comes under the category of precious stones, be it gold, silver, art objects, or other precious stones, even platinum for that matter. We have a lot of options here, stones as well as metals. People prefer investing, and gold is considered to be one of the safest investment these days. Why? Because when the stock market tanks, when there is a crash somewhere, even if the 9/11 attack which happened, or if there is a tsunami, or if there is any sort of natural calamity, a financial crisis, we always observe that the prices of gold start, they become really high. They touch the sky. The reason is that you can always have gold with you and go wherever you wish to. You can buy and sell gold across the globe. But the funds which you have, the currency which you are having right now may not be useful. All of us have experienced the same thing when demonetization was announced. The 500 rupee notes became useless suddenly. But the gold, the pieces of gold, the pieces of silver still carried value. And the mindset is that if you have gold, if you have silver with you, it is considered to be one of the safest investment alternative, because it is never going to get doomed. And the growth which gold, the growth with which silver prices have risen over the past years, it is tremendous. And that is why it is considered to be a big asset owned by the households in India. The next and the last investment alternative is financial derivatives. The word derivatives, if we look at the literal meaning of the word derivatives, it means an asset which is deriving its value from some other underlying asset. That means financial derivatives as such are not assets, but they are actually deriving their value from some other financial asset. And then under this category, we have two different types of derivatives. The first one is futures, and the second is your options. Futures contracts are the contracts for which you enter into to buy a buy or in fact or sell. You have the option. You can buy or sell a particular financial asset, a particular commodity, a particular share at a later date but at a predetermined price. I repeat, financial derivatives are the contracts, the futures contracts are one of those financial derivatives wherein you are entering the contract today. Once you enter the contract, either to buy or sell an asset, that asset, say for example, is a share. You decide that you are going to buy or sell a particular share after say 20 days but at a price which is being fixed today. This is very much witnessed in the spot market as well. For example, if you go to Delhi 6 or if you go to Chandni Chowk or if you go to the wholesale markets, most of the deals happen and the wholesale deals take place for a future date, but the price is determined then and there. That is known as a forward contract. When you're doing some contract, entering into a financial obligation today, for a future date at a predetermined price, that becomes a forward contract. But when you are dealing with stocks, when you are dealing with certain commodities or when you are dealing with certain metals which are listed on an exchange, or it can be a commodity exchange, it can be stock exchange, and you decide to buy or sell these commodities, these assets or these securities at a future date, but you fix the price today, that becomes a futures contract. So when it comes to obliging, there is an obligation attached to this futures contract. Let me cite one example. For example, you decide to buy the shares of say Reliance Industries, 100 shares of Reliance Industries, and we are just assuming, we are taking a hypothetical example at a price of rupees 1100 per share after 20 days. So today you are entering into a contract stating that you are going to buy 100 shares of Reliance Industries at a price of say 1100 after 20 days. Now here, once you have entered into this contract, you pay some token amount of money today and you fix the contract. You enter into this contract. After a span of 20 days, you have the obligation. You will have to oblige by this specific contract and you cannot say no. So you will have to undertake, you will have to buy these shares, these 100 shares of Reliance Industries at a price of 1100. Continuing with this example and to further elaborate on the second type of financial derivative, which is options, let us assume that today you enter into the same contract. You say, I want to buy 100 shares of Reliance Industries at a price of 1100 after 20 days. But you do not want to enter into the obligation. You want to look at the scenario at that time after 20 days and then you decide whether you want to buy or you do not want to buy. So without any sort of foundation. In this scenario, you can go for call option. Call option gives you the right to buy a particular share at a later date at a predetermined price. That means if you decide that you want to buy 100 shares of Reliance Industries at 1100 after 20 days, but after 20 days you find that the same share is readily available at 1080 rupees in the spot market. In that case, you will prefer not to go in for this call option. You will not exercise this call option. Rather, you will prefer to buy the same shares in the stock market from the spot market. So here you have, under the call option, you have got the right to buy, but there is no obligation to buy. Whereas when we were talking about futures market, in futures contract, there was an obligation. You had to fulfill that obligation. You will have to buy in case of futures, but in options, you have the right but not the obligation. There is no foundation on you. The second type of option, one is call option. The second type of option is your put option. Under put option, you get the right to sell particular share or particular asset or a particular commodity at a later date, but the price is decided then and there. That means at a predetermined price. So continuing with the same example, We again take 100 shares of Reliance Industries at 1100. Now, under put option, you are buying the right to sell these shares. Today, you are buying the right to sell 100 shares of Reliance Industries at a price of say 1100 after 20 days. Now, if you look at after 20 days, you find that the current market price in the spot stock market of Reliance Industries is say 1200. Being an intelligent investor, you will not exercise this put option. That means you will not prefer to sell these shares under the options market, in the financial derivatives market. Instead, you will prefer selling these shares in the stock market. This means you bought the right to sell, but there was no obligation, there was no foundation on you to actually exercise that option. So that is the broad difference between futures and options. If you look at futures, there is an obligation. Under options, there is no obligation. And under options, we have call option and then we have put option. Call option gives you the right to buy and put option gives you the right to sell. With this, we summarize all the investment alternatives available to an investor these days. The next topic which we move on to is investment versus speculation. What is investment? When you do investment, an investment is usually done with an expectation of return by taking the calculated risk. Whereas when you look at speculation, speculation is, the word itself says that you are speculating, you are predicting without much calculation of the risk. So, if you look at the major points of difference between investment and speculation as is visible on the screen, the first difference, the point of comparison is planning horizon. An investment is usually made with a long investment horizon. The time for which you want to stay invested is usually long, whereas in case of speculation, the planning horizon is usually short. That means you are investing today and you want immediate results. You are investing today and you want maybe the results to happen tomorrow, or maybe a day, 2 days, 3 days, maximum a week or a month, not beyond that. But when we invest, we usually invest for 6 months at least, 7 months, 1 year, 2 years, 3 years, 4 years, 5 years, or maybe more than that. Like the example we talked about in putting your funds in real estate. Now, when you're putting your funds in some property, you stay invested for a longer duration of time vis-a-vis speculation. The next point of difference between investment and speculation is the risk disposition. That means how much risk is involved when we are investing and how much is involved when we are speculating. When you are investing your funds, because you have done some sort of analysis, because there is some sort of analysis which has gone into it before this decision is taken, the risk appetite, the risk which is taken is usually low to moderate. Whereas when you are speculating, when you are investing on just hearsay, when you are just putting your funds without even knowing where you're putting and how much return you can expect, the risk equally is very, very high. And because risk and return, they move in tandem with each other, the return expectation in case of investments, it is a satisfactorily moderate return, whereas in case of speculation, because of high amount of risk involved, in fact very high amount of risk involved, the return expectation is also pretty high. You want, because your funds are at stake, there is lot of risk which is involved, that is why you expect the returns to be pretty high. Now, how do you decide that you are going to invest, or are you going to put your money, or you are speculating? So the main fundamental, or we can say the basis for deciding of investment is your fundamental factors, the analysis. Say for example, if you are buying some shares, you are actually doing the fundamental analysis. A very famous investor, Warren Buffett, he always says that he never invests or never parks his funds anywhere unless he understands the business of that company. So that's actually investment. But a technical trader or a very popular technical analyst named Jesse Livermore, he invested on the basis of technical charts, he invested on the basis of market psychology, he invested on the basis of hearsay. And there was the analysis was actually baseless if we talk about. If you do not understand the business of the company in which you are putting your funds in, you are actually speculating because there is no base on the basis of which you are investing. So if you look at the major difference between investment and speculation, investment is made on the after analyzing, after studying, after in-depth analysis of fundamental factors, whereas in case of speculation, it is complete hearsay, it is complete technical charts, it is completely or dependent on market psychology. What others are thinking, what others are feeling. So if the vibes in the market are positive, you speculate that the market will rise. But if the vibes are negative, you speculate that the market will go down, and you start predicting that tomorrow markets will be down without any reason, without any logic. And then the last point of difference between investment and speculation is the amount of leverage, the amount of borrowed funds involved. Usually when we make an investment, say for example, if you are buying a house, when you buy a house, you have some amount of your own funds which have been saved, and then you go in and you opt for a home loan. So you are using your own funds and you are borrowing some funds from the bank to invest your money in a house. That is investment. But when you are speculating, you will take the same example. You want to invest in a property, but here when you are investing, you are just speculating, considering that because the floor price, the price of one particular area or one particular land or the demand for that area is likely to rise without any basis, without any logic. You are just speculating that the prices will rise. What do? You borrow funds from your friend, or you just contact a bank, and then you try to borrow funds and start putting your money in that property. You put all your funds there, but they are not your own funds. And then you expect that you're going to sell this off the next day or maybe in a week's time. What are you doing? You are actually speculating. You are borrowing funds and putting those borrowed funds in that property without even analyzing that whether there is sufficient demand, whether the funds which we are putting there, is the land or is the property worth it? There's no analysis. Most of the times the investment is done with the help of own as well as borrowed funds, whereas in case of the speculation, it is the borrowed funds which are used. With this, we are done with the comparison between investment and speculation, and the last topic for today is gambling. Gambling is, as the word suggests, is a pure gamble. That means we say that the result is known very quickly, immediately, and rational people never gamble for income. They always gamble for fun. They never put their funds just for generating income. For example, when you toss a coin, you don't know whether it's going to be heads or tail. What is the outcome of a roll of a dice? When you turn a card, you don't know what that card would be. This is pure gambling. So we can say that gambling is actually based on artificially created risk, and it is not an economic activity, and we must discourage gambling because it is far more dangerous as we compared it with speculation, because the result is known more quickly, but the risk quantum is too high. There is no analysis at all. We always see that rational people will never ever gamble for earning funds. It is completely based on artificially created risk, so not to be promoted as an economic activity. The examples as I cited, so when you're tossing a coin, you do not know what's going to happen, whether it's heads or tail. So for fun, as a game activity, gambling can be done, but otherwise it should be discouraged. So with this, I finish today's session. Just one request to you: stay curious, keep learning, and keep growing. Rather than finding interesting things, stay interested to learn new things. Thank you so much. Happy learning.